Money shapes every part of your life. It decides what you can buy, all items, where you can live, and how you plan your future. Yet most people never truly understand what money is. They work for it. They save it. They spend it. But they rarely question how it works. For investors, this lack of understanding is dangerous. Because if you do not understand money, you cannot understand wealth. Many people believe wealth comes from hard work alone. Others think it comes from luck or special opportunities, but in reality, wealth is deeply connected to the type of money you use. Throughout history, money has constantly changed, from shells and stones to gold and paper, and now to digital forms. Each change has shaped economies, destroyed fortunes, and created new ones. Those who understood these changes early gained massive advantage. Those who ignored them often lost everything. Today, we are living through another major shift. A shift from government-controlled money to decentralized digital money. A shift that could redefine how value is stored and transferred. This is where Bitcoin enters the story. But before you can understand Bitcoin, you must first understand money itself. Because Bitcoin is not just technology, it is a new form of money built on old principles. If you skip the basics, Bitcoin will seem confusing and risky. But if you understand the foundation, everything becomes clear. This journey begins with a simple question. What is money? Part 1. Money. Before we talk about Bitcoin, we must understand money. Because Bitcoin is not just an invention, it is a response to problems that have existed for thousands of years. Money is one of the most powerful tools ever created by humans. It allows strangers to cooperate without trust. It allows value to move across time and space. But money is not fixed. It evolves with society, and every form of money carries strengths and weaknesses. Some forms of money protect wealth. Others slowly destroy it. Some encourage saving and long-term thinking. Others encourage spending and short-term behavior. As an investor, this difference is everything. Because your success does not depend only on what you invest in. It also depends on the kind of money you use to store your value. Throughout history, people have experimented with many types of money. Some worked for a short time. Some lasted for centuries. Very few stood the test of time. By studying this evolution, you begin to see patterns. You begin to understand why certain forms of money rise and why others eventually fail. This knowledge gives you an edge. It helps you think differently from the crowd. It helps you protect your wealth in uncertain times. And most importantly, it prepares you to understand Bitcoin. Because Bitcoin is not random, it follows the same economic rules that have always governed money. So before we move forward, we start with the most important question. What is money? Chapter 1. What is money? Money is one of the most important inventions in human history. It is something we use every day, yet most people never stop to ask what it really is. At its core, money is a tool for exchange. It allows people to trade goods and services without needing direct barter. Imagine a world without money. If you grow wheat and want shoes, you must find a shoemaker who wants wheat. This is called barter. It is slow, inefficient, and limits trade. Money solves this problem. It acts as a common medium that everyone accepts. You can sell your wheat for money. Then use that money to buy shoes from anyone. This simple idea changes everything. Money has three main roles. First, it is a medium of exchange. Second, it is a store of value. Third, it is a unit of account. As a medium of exchange, money makes trade easier. It removes the need for double coincidence of wants. This means two people do not need to want exactly what the other offers. As a store of value, money allows you to save. You can work today and spend later. This connects your present effort to your future rewards. As a unit of account, money helps measure value. It allows prices to be compared easily. This helps people make better economic decisions, but not all money is equal. For something to work as good money, it must have certain qualities. It must be durable. It should not break or decay over time. It must be portable. You should be able to carry it easily. It must be divisible. You should be able to split it into smaller units. It must be recognizable. People should easily verify it as real. Most importantly, it must be scarce. It should be hard to create more of it. Scarcity is what gives money its value. If money can be created easily, it loses purchasing power. This is where many modern systems fail. In the past, people chose money naturally. They selected items that best met these qualities. Over time, better forms of money replaced weaker ones. This process was not controlled by governments. It was driven by human action and economic logic. As trade expanded, societies needed better money. They needed something that could store large amounts of value, something that could last across generations. This led to the rise of stronger forms of money. Another important concept is time preference. Time preference is how people value the present compared to the future. High time preference means choosing immediate rewards. Low time preference means being willing to wait for bigger future rewards. Money plays a big role in this behavior. When money holds its value well, people are more likely to save. They think long-term. They invest in skills, businesses, and assets. But when money loses value quickly, people behave differently. They spend fast. They avoid saving. They focus on short-term gains. This has a deep impact on society. Good money encourages stability, planning, and growth. Bad money leads to uncertainty and poor decisions. For investors, this idea is critical. If you are saving in weak money, your wealth slowly disappears. Even if you think you are being careful. If you are using strong money, your savings are protected. You gain more control over your future. This is why understanding money is not optional. It is essential. Most people focus only on investments. They look for stocks, real estate, or new opportunities, but they ignore the foundation. They ignore the money itself. This is like building a house on weak ground. No matter how strong the structure looks, it will not last. Strong money is the foundation of wealth. Throughout history, the best forms of money have shared one key feature. They were hard to produce. This limited supply protected their value. When new forms of money are introduced, they must compete with existing ones. People naturally choose what works best. This competition improves money over time. However, when control is centralized, this process changes. The ability to create money easily leads to abuse. It leads to inflation and loss of value. This shifts wealth away from savers and toward those who control money creation. Understanding this dynamic helps investors think clearly. It helps them see beyond short-term price changes. It helps them focus on long-term value. Money is not just paper or numbers on a screen. It is a system that shapes behavior. It influences decisions at every level of society. When you understand money, you begin to see the world differently. You understand why some economies grow and why others struggle. You understand why some people build wealth and why others lose it over time. This knowledge gives you an advantage. It allows you to make better financial decisions. It helps you protect your purchasing power. And it prepares you for what comes next, because money is evolving again. To understand that evolution, we must first understand where money started. Chapter 2. Primitive money. Before gold, before paper, and long before digital money, humans used simple items as money. These early forms are known as primitive money. Primitive money was not created by governments. It emerged naturally as people searched for better ways to trade. In early societies, people relied on barter. They exchanged goods directly. A farmer traded grain for tools. A hunter traded meat for clothing. But barter had serious problems. The biggest problem was the double coincidence of wants. Both people had to want exactly what the other offered. This made trade slow and difficult. To solve this, people began using commonly accepted items as money. These items varied across cultures. Some used shells, some used salt, some used cattle, others used beads or stones. These items worked as money because people trusted them. They were widely accepted within their communities, but they were far from perfect. Take cattle as an example. Cattle can store value, but they are not divisible. You cannot easily divide a cow into smaller units without destroying its value. Shells were more portable, but they were not always scarce. If more shells were found easily, their value dropped. Salt was useful and widely accepted, but it could be damaged or dissolved. Each form of primitive money had limitations. These limitations created problems as societies grew. As trade expanded, people needed better money. They needed something more reliable, more durable, and more scarce. Primitive money worked well in small communities, but it struggled in larger economies. Another important issue was storage of value. Good money should hold its value over time. But many primitive forms failed at this. If a society discovered a new source of shells or salt, supply increased. This reduced their value. This is similar to inflation in modern times. When supply increases too easily, money loses purchasing power. For investors, this is a key lesson. Money must be hard to produce. If it is easy to create, it cannot protect wealth. Primitive money also faced challenges in transportation. Carrying large amounts of cattle or salt was not practical. This limited trade over long distances. As trade routes expanded, this weakness became more clear. People needed money that could travel easily. Another issue was standardization. Primitive money often lacked uniformity. One shell might not be equal to another. One animal might be stronger or weaker than another. This made pricing difficult. Without standard units, measuring value becomes complicated. This slows down economic growth. Despite these weaknesses, primitive money played an important role. It was the first step in the evolution of money. It showed that humans naturally move toward better systems. When a form of money fails, people look for alternatives. This process leads to innovation. Over time, societies discovered better materials for money. They began to use metals. Metals solved many of the problems of primitive money. They were durable, they were divisible, they were easier to transport. Most importantly, some metals were scarce. This scarcity made them more reliable as a store of value. Gold and silver eventually became dominant. They replaced primitive money in most advanced societies. This transition was not sudden. It happened slowly over time. People shifted gradually as they recognized the advantages of metals. This is another important lesson for investors. Better money does not appear overnight. It competes with existing systems. It gains trust slowly. But once it proves superior, adoption accelerates. Primitive money teaches us something deeper about human behavior. People do not need central authorities to choose money. They naturally select what works best. They choose what protects their wealth. They choose what makes trade easier. This process is driven by incentives, not rules. Understanding this helps investors think independently. It helps them question current systems. It helps them recognize when a better form of money is emerging. Primitive money also highlights the importance of trust. Money works because people believe others will accept it. This shared belief creates value. But trust alone is not enough. If the supply of money can be increased easily, trust breaks down over time. This is why scarcity is critical. Scarcity protects trust. Without it, money becomes unreliable. As societies became more complex, the need for better money increased. Trade expanded across regions and continents. People needed a form of money that could handle this growth. Primitive money could not meet these demands. It was too limited, too unstable, and too inefficient. This led to the next stage in the evolution of money. The rise of monetary metals. These metals would solve many of the problems of primitive money. They would become the foundation of global trade for centuries, and they would set the standard for what strong money looks like. Chapter 3. Monetary metals. As societies grew larger and trade expanded across regions, the limits of primitive money became clear. People needed a form of money that was more reliable, more durable, and easier to use. This need led to the rise of monetary metals. Metals had unique properties that made them ideal for money. They were strong and long-lasting. They could be divided into smaller units without losing value. They were easy to transport compared to livestock or bulky goods, but not all metals became money. The ones that succeeded shared a key feature. They were scarce and difficult to produce. Gold and silver became the dominant forms of money across civilizations. These metals were not chosen by governments. They were chosen by people through repeated use in trade. Over time, gold and silver proved to be superior. Gold in particular became the ultimate store of value. It is rare in nature, it does not corrode or decay. It can be melted and reshaped without losing quality. These qualities made gold highly reliable. Silver also played an important role. It was more abundant than gold and useful for smaller transactions. Together, gold and silver created a strong monetary system. Gold was used for storing large amounts of value. Silver was used for everyday transactions. This system supported trade across continents. Merchants could travel long distances carrying value in a compact form. This helped expand global commerce. Another advantage of metals was standardization. Coins were introduced to make trade easier. These coins had fixed weights and purity. This allowed people to trust their value. Instead of weighing metal for every transaction, people could use coins directly. This increased efficiency and reduced friction in trade. Governments later began minting coins. They stamped them with official markings. This helped guarantee weight and purity. However, this also introduced new risks. When governments gained control over coin production, they sometimes abused this power. They reduced the amount of precious metal in coins while keeping the same face value. This process is known as debasement. Debasement allowed governments to create more money without increasing real value. This led to inflation and loss of trust. For investors, this is an important lesson. Even strong money can be weakened if control is centralized. Scarcity must be protected. If supply is manipulated, value is destroyed. Another key concept related to metals is stock to flow. Stock refers to the total existing supply of a metal. Flow refers to the new supply produced each year. Gold has a very high stock to flow ratio. This means that new production adds only a small amount to the total supply. This makes gold stable and resistant to inflation. Silver has a lower stock to flow ratio than gold. This makes it slightly less stable as a store of value. This difference explains why gold became the preferred store of wealth. High stock to flow creates predictability. Investors value predictability because it reduces risk. When supply is stable, purchasing power is preserved. Monetary metals also influenced human behavior. Because gold and silver held value well, people were encouraged to save. Saving allowed for long-term planning. People invested in businesses, infrastructure, and innovation. This led to economic growth and progress. Low-time preference behavior became more common. People thought about the future instead of only the present. This is one of the hidden powers of strong money. It shapes how people think and act. However, metals were not perfect. They had limitations. Transporting large amounts of gold could still be risky. Storage required security. Verification of purity could be difficult without proper tools. As economies became more complex, these challenges increased. This led to the development of new systems built on top of metals. Banks began to store gold and issue paper receipts. These receipts represented claims on the stored metal. People found it easier to trade paper instead of carrying heavy coins. This was the beginning of a major shift. Money was becoming more abstract. Instead of using physical metal, people started using representations of value. At first, these systems were backed fully by gold, but over time this changed. Banks and governments realized they could issue more paper than the gold they held. This created new risks. It introduced the possibility of inflation and financial instability. This shift marked the beginning of modern monetary systems. It moved money further away from its physical foundation. For investors, this transition is critical to understand. It shows how strong money can gradually become weak. It shows how trust can be stretched and eventually broken. Monetary metals set the standard for what good money should be. They demonstrated the importance of scarcity, durability, and independence from control. But they also revealed the risks of centralization and manipulation. These lessons are essential for understanding what comes next. Because the next stage of money takes a very different path. It moves away from physical scarcity and towards systems controlled by governments. Chapter 4. Government money. As economies expanded and trade became more complex, carrying physical gold and silver became less practical. People needed a more convenient way to store and transfer value. This led to the rise of banks. Banks offered a simple service. They stored gold and issued paper receipts in return. These receipts represented ownership of the gold stored in the bank. People could trade these receipts instead of moving heavy metals. This made transactions faster and easier. At first, this system worked well. Each paper note was backed by real gold. People trusted that they could redeem their notes at any time. But over time, things began to change. Banks realized that not everyone would withdraw their gold at the same time. This gave them an opportunity. They started issuing more paper notes than the gold they actually held. This practice is known as fractional reserve banking. It allowed banks to create money out of nothing. As long as people trusted the system, it continued to work. But this trust was fragile. If too many people demanded their gold at once, the bank would fail. This is called a bank run. To manage these risks, governments stepped in. They began regulating banks and supporting the financial system. Eventually, governments took full control of money. They created central banks. Central banks gained the power to issue currency and control the money supply. At first, currencies were still linked to gold. This was known as the gold standard. Under this system, governments promised to convert paper money into gold on demand. This limited how much money they could create. But this limitation was seen as a problem by governments. They wanted more flexibility. They wanted to spend more, especially during wars and economic crises. So they began to break the link with gold. This process happened gradually, and eventually, most countries abandoned the gold standard completely. This created a new system known as fiat money. Fiat money is money that has value because the government says it does. It is not backed by any physical commodity. Its value depends on trust and legal enforcement. Governments can create fiat money in unlimited amounts. This is where the main problem begins. When money can be created easily, its value decreases over time. This leads to inflation. Prices rise, purchasing power falls. People need more money to buy the same goods. For investors, this has serious consequences. Saving in fiat money becomes risky. Even if you keep your money safe, its value erodes. This forces people to invest just to preserve their wealth. It changes behavior across society. Instead of saving, people spend quickly. Instead of long-term planning, they focus on short-term gains. This increases time preference. It leads to more risk-taking and financial instability. Another issue with government money is control. Central banks can influence interest rates. They can decide how much money enters the economy. This gives them significant power, but it also creates distortions. Artificially low interest rates encourage borrowing. This can lead to bubbles in assets like real estate and stocks. When these bubbles burst, the economy suffers. These cycles of boom and bust are common in fiat systems. For investors, understanding these cycles is important. It helps explain market behavior. It helps explain why prices rise rapidly and then fall suddenly. Government money also redistributes wealth. Those closest to money creation benefit first. This includes banks, governments, and large institutions. They receive new money before prices rise. This is often called the hidden tax of inflation. Ordinary people are affected later. By the time money reaches them, prices have already increased. This reduces their purchasing power. Over time, this creates inequality. It rewards those who control money and penalizes those who save in it. Despite these problems, fiat money dominates the world today. It is convenient, it is widely accepted, and it is supported by governments. But convenience comes with a cost. That cost is long-term loss of value. For investors, this reality cannot be ignored. You must understand the system you are operating in. You must recognize how money is created and how it affects your wealth. Government money represents a major shift from the past. It moves away from scarcity and toward flexibility and control, but this flexibility often leads to instability. This raises an important question. Is there a better form of money? A form that combines the strengths of gold with the convenience of modern technology, a form that is scarce, secure, and independent of central control. To answer that question, we must first understand a key concept. The relationship between money and human behavior. Chapter 5. Money and time preference. To understand money deeply, you must understand human behavior. And one of the most important ideas that connects money and behavior is time preference. Time preference is the degree to which people prefer present rewards over future rewards. In simple terms, it answers one question. Do you want something now, or are you willing to wait for something better later? If someone chooses immediate pleasure over long-term benefit, they have high time preference. If someone is willing to delay gratification for a greater reward, they have low time preference. This concept may seem simple, but it shapes entire economies. And money plays a central role in determining time preference. When people trust that their money will hold value over time, they are more likely to save. They feel confident that their effort today will still be valuable in the future. This encourages long-term thinking. People invest in education. They build businesses. They plan for future generations. This is the behavior that creates strong and stable societies. On the other hand, when money loses value quickly, behavior changes. People begin to doubt the future value of their savings. They feel pressure to spend now rather than later. This creates high time preference behavior. Instead of saving, people consume. Instead of planning, they react. This leads to weaker economic structures. For investors, understanding this shift is critical. Because your environment affects your decisions. If you live in a system where money is constantly losing value, you are pushed toward riskier behavior. You are encouraged to chase returns. You are encouraged to speculate. Not because you want to, but because you must protect your purchasing power. This creates a cycle. As more people chase short-term gains, markets become more volatile. Prices rise quickly and fall suddenly. This increases uncertainty, and uncertainty further increases time preference. Strong money breaks this cycle. When money holds its value, people do not feel forced to take unnecessary risks. They can save with confidence. They can make decisions based on long-term value instead of short-term survival. This leads to healthier investment strategies. Instead of chasing trends, investors focus on fundamentals. Instead of reacting emotionally, they act rationally. This is one of the biggest advantages of low time preference. It creates discipline. Discipline is the foundation of successful investing. Another important effect of time preference is capital formation. When people save, they create capital. This capital is used to build businesses, infrastructure, and technology. It fuels economic growth. But if people do not save, capital formation slows down. This limits innovation and development. High-time preference societies often struggle with long-term projects. They prioritize immediate results over sustainable growth. This can be seen in many economic systems. Where money is weak, savings are low. Where savings are low, investment is unstable. For investors, this environment is challenging. It becomes harder to find true value. Short-term noise dominates long-term fundamentals. Understanding time preference helps you step back from this noise. It helps you see the bigger picture. It reminds you that wealth is built over time, not overnight. Another important point is that time preference is not fixed. It can change based on conditions. Even disciplined individuals can shift toward high time preference in unstable systems, and even average individuals can develop low time preference in stable systems. This shows how powerful money is. It does not just facilitate trade, it shapes human behavior. This is why the quality of money matters so much. Good money encourages patience. Bad money encourages urgency. Good money rewards saving. Bad money punishes it. For investors, aligning with low time preference is essential. It allows you to think clearly. It allows you to avoid emotional decisions. It allows you to stay focused on long-term goals. But this is not easy in a world of constant noise. Markets move quickly. News spreads instantly. Opportunities appear and disappear in moments. This environment pushes people toward high time preference, but the most successful investors resist this pressure. They understand that real wealth takes time. They focus on preserving capital first and growing it steadily over time. Money that holds value makes this approach possible. Money that loses value makes it difficult. This is why understanding time preference is not just theory. It is practical. It affects how you save. It affects how you invest. Asos. It affects how you think about the future. As we continue this journey, we begin to see a pattern. The strength of money shapes the strength of behavior, and behavior shapes the strength of economies. This leads us to the next important concept. What defines a monetary standard? How do societies choose their form of money? And what happens when that standard changes? Chapter 6. The Monetary Standard. To understand money at a deeper level, we must understand the idea of a monetary standard. A monetary standard is the foundation of a money system. It defines what gives money its value. In simple terms, it answers one question. What is money backed by? Throughout history, different societies have used different standards. Some used physical goods like shells or salt. Others used metals like gold and silver. Today, most countries use fiat money. Each standard shapes how money behaves and how people behave around money. The most important monetary standard in history was the gold standard. Under the gold standard, money was directly linked to gold. Paper currency represented a claim on a fixed amount of gold. People could exchange their notes for gold at any time. This created discipline in the system. Governments could not create unlimited money, because each unit had to be backed by real gold. This limited inflation. It protected the purchasing power of money. For investors, this created a stable environment. Prices were more predictable. Long-term planning was easier. Saving was rewarded. The gold standard encouraged low-time preference behavior. People trusted that their money would hold value, so they were willing to delay consumption. This led to higher savings and more investment in productive activities. Economic growth under this system was often steady and sustainable, but the gold standard also had challenges. It limited government spending. During times of crisis, governments wanted more flexibility. They wanted to increase spending without raising taxes. But the gold standard restricted this ability. This created tension. Over time, governments began to weaken the link between money and gold. They printed more paper than the gold they held. At first, this was done quietly. Later, it became official policy. The final break came when countries completely abandoned gold backing. This marked the shift to fiat monetary standard. Under fiat, money is not backed by any physical asset. Its value comes from government decree and public trust. Central banks control the supply of money. They can increase or decrease it based on policy decisions. This gives them powerful tools. They can stimulate the economy. They can manage interest rates. They can respond quickly to financial crises. But this flexibility comes with risks. Without a fixed standard, there is no natural limit on money creation. This can lead to excessive printing, which leads to inflation. Over time, this reduces the value of money. For investors, this changes the entire landscape. You can no longer rely on money to preserve value. You must actively seek assets that can protect your wealth. This is why investing becomes necessary in a fiat system. Saving alone is not enough. Another effect of the fiat standard is economic cycles. Central banks influence interest rates. Low interest rates encourage borrowing and spending. This can lead to economic expansion, but it can also create bubbles. When borrowing becomes too high, the system becomes unstable. Eventually, these bubbles burst. This leads to recessions or financial crises. These cycles are a natural result of artificial intervention. For investors, understanding these cycles is essential. It helps you avoid emotional decisions. It helps you prepare for both growth and downturns. Another important concept is trust. All monetary systems depend on trust. Under the gold standard, trust was based on physical backing. Under fiat, trust is based on institutions. People trust that governments will manage money responsibly, but history shows that this trust is often broken. Many currencies have lost value over time. Some have collapsed completely. This raises an important question. Is it possible to have a monetary standard that combines stability and flexibility? A system that is both scarce and efficient. A system that does not rely on trust in central authorities. This question becomes more important in a digital world, where transactions happen instantly, where economies are global. The search for a better monetary standard continues. For investors, this search is not theoretical. It directly affects how you store and grow your wealth. Understanding the strengths and weaknesses of each standard gives you an advantage. It helps you position yourself for the future. It helps you recognize shifts before they become obvious. As we move forward, we will explore another key concept that affects every monetary system: inflation, how it works, why it happens, and how it impacts your wealth. Chapter 7. Inflation. Inflation is one of the most important concepts in money, yet it is also one of the most misunderstood. Most people think inflation means rising prices, but this is only the visible effect. At its core, inflation is the increase in the supply of money. When more money enters the system, each unit of money becomes less valuable. This is what causes prices to rise over time. Think of it in simple terms. If the amount of goods stays the same, but the amount of money increases, prices must adjust. More money is chasing the same goods, so the value of money falls. This is inflation. In a fiat system, inflation is common. Central banks have the power to create new money. They do this through various methods. They lower interest rates. They buy financial assets. They expand credit through banks. All of this increases the money supply. At first, this may seem beneficial. More money can stimulate economic activity. It can increase spending and investment, but over time, the effects become clear. Prices begin to rise. Savings begin to lose value. For investors, inflation is a silent force. It does not destroy wealth instantly. It erodes it slowly over time. This makes it dangerous, because many people do not notice it until it is too late. Consider someone who saves money without investing. They may feel secure. Their money is safe. But if inflation is high, their purchasing power declines every year. They can buy less with the same amount of money. This is why inflation is often called a hidden tax. It reduces wealth without direct action. Another important concept is the difference between expected and unexpected inflation. Expected inflation is already built into the system. People anticipate it. They adjust their behavior accordingly. Interest rates may rise to compensate. Investors may choose assets that protect value. Unexpected inflation is more dangerous. It catches people off guard. It disrupts plans. It creates uncertainty. This can lead to economic instability. Inflation also affects different people in different ways. Those who receive new money early benefit the most. This includes banks, governments, and large institutions. They can spend the money before prices rise. This effect is known as the Cantillon effect. Those who receive money later are at a disadvantage. By the time they receive it, prices have already increased. This reduces their purchasing power. Over time, this creates inequality. Wealth shifts toward those closest to money creation. For investors, understanding this dynamic is important. It helps explain why certain assets rise faster than others. It helps explain why financial markets often move before the real economy. Another key point is that inflation changes behavior. When people expect prices to rise, they act differently. They spend sooner rather than later. They borrow more. They save less. This increases time preference. It pushes people toward short-term thinking. This can lead to poor investment decisions. Chasing quick gains. Ignoring long-term value. This is why inflation is not just an economic issue. It is a behavioral issue. It affects how people think about the future. Strong money reduces inflation. When supply is limited and predictable, purchasing power is preserved. This encourages saving. It encourages long-term planning. This creates a healthier economic environment. In contrast, weak money leads to continuous inflation. Even if it is slow, it accumulates over time. A small loss each year becomes a large loss over decades. For investors, this reality cannot be ignored. You must account for inflation in your strategy. It is not enough to grow your money. You must grow it faster than inflation. Otherwise, you are losing value in real terms. This is why many investors turn to assets like real estate, stocks, and commodities. These assets can rise in value as inflation increases, but they also come with risks. They can be volatile. They can be affected by market cycles. This creates a challenge. How do you protect your wealth from inflation without taking excessive risk? This question has no simple answer, but understanding inflation is the first step. It allows you to think clearly. It helps you separate real growth from nominal growth. It helps you make better decisions over time. Another important point is that inflation is not always visible immediately. It can take time to appear in consumer prices. Sometimes it shows up first in asset prices. Stocks rise, real estate rises. This can create the illusion of prosperity. But in reality, it may just be the effect of increased money supply. For investors, recognizing this difference is critical. It helps you avoid false signals. It helps you focus on true value. Inflation is a constant force in modern economies. It shapes markets. It shapes behavior. It shapes wealth distribution. Understanding it gives you an advantage. It allows you to protect your purchasing power. And it prepares you for the next concept. How money moves through the system in different forms, how it is represented, transferred, and expanded. Chapter 8. Monetary Media and Instruments. Money does not exist in just one form. It moves through the economy in different ways. It takes different shapes depending on how it is used. To understand modern finance, you must understand monetary media and instruments. Monetary media refers to the different forms that money can take. This includes physical cash, bank deposits, and digital balances. Each form represents value, but not all forms are equal. Some are more secure. Some are more convenient. Some carry more risk. Physical cash is the simplest form of money. It is direct and immediate. When you hold cash, you fully control it. There is no third party involved, but cash has limitations. It is not easy to transfer over long distances. It can be lost or stolen. It is not efficient for large transactions. To solve these problems, banking systems developed. Banks allow people to store money safely. Instead of holding cash, people deposit money in banks. These deposits become digital balances. You can transfer these balances easily. You can make payments without physical exchange. This increases efficiency. But it also introduces a new factor: trust. When your money is in a bank, you do not control it directly. You trust the bank to hold and manage it. This creates counterparty risk. If the bank fails, your money may be at risk. Another important concept is that bank deposits are not the same as cash. When you deposit money, the bank does not keep it idle. It lends it to others. This creates new money in the system. This process expands the money supply. It is a key part of modern economies, but it also creates instability. Because the same base money supports multiple claims. If too many people try to withdraw their money at once, the system can break. This is similar to the bank runs discussed earlier. Monetary instruments are tools built on top of money. These include checks, credit cards, and digital payment systems. They make transactions faster and more convenient. You can pay instantly without moving physical money. But each layer adds complexity, and each layer introduces new risks. For example, credit cards allow spending without immediate payment. This increases consumption, but it also increases debt. Debt can be useful when used carefully. It can help businesses grow. It can help individuals invest in opportunities. But excessive debt creates problems. It increases financial fragility. It makes the system more sensitive to shocks. Another important instrument is digital payment networks. These systems allow instant global transactions. They connect banks, businesses, and individuals. This has transformed the way money moves, but these systems are centralized. They can be controlled. They can be monitored. They can be restricted. This introduces another dimension: financial freedom. When money is fully controlled by intermediaries, access can be limited. Transactions can be blocked. Accounts can be frozen. This creates dependency on institutions. For investors, this is an important consideration. Control over your money is as important as its value. Convenience often comes at the cost of control. Another key idea is that the further money moves from its base form, the more risk it carries. Physical cash has minimal counterparty risk. Bank deposits have more risk. Complex financial instruments carry even more risk. This layered system creates both efficiency and vulnerability. It allows economies to grow rapidly, but it also makes them more fragile. Small disruptions can spread quickly. This is why financial crises can have wide impact. They are not isolated events. They affect the entire system. Understanding monetary media helps investors see where risk exists. It helps you evaluate how your money is stored and used. It helps you decide how much risk you are willing to take. Another important point is liquidity. Liquidity means how easily you can access your money. Cash is highly liquid. Some investments are less liquid. You may not be able to convert them quickly without loss. Balancing liquidity and return is a key part of investing. Monetary instruments influence this balance. They can increase liquidity, but they can also create hidden risks. For example, easy access to credit increases spending, but it can also lead to overextension. For investors, awareness is essential. You must understand the tools you use. You must understand how money flows through the system. You must recognize where risks are hidden. This knowledge gives you control. It allows you to make informed decisions. It helps you avoid unnecessary exposure. As we complete part 1, a clear picture begins to form. Money evolves over time. From primitive forms to metals, from metals to government-controlled systems, from physical forms to complex digital structures. Each step brings benefits, and each step introduces new risks. Understanding this evolution is the foundation. It prepares you for the next stage. Because now we move from traditional money systems to something entirely new. A system designed to solve many of the problems we have discussed. A system built on technology instead of trust. A system that aims to combine scarcity with digital efficiency. Part 2. Bitcoin. After understanding the history and evolution of money, a clear pattern begins to emerge. Every form of money rises to solve a problem, and every form of money eventually reveals new weaknesses. Primitive money failed because it was not efficient. Monetary metals solved that, but were difficult to move and store. Government money improved convenience, but introduced inflation and central control. Each step brought progress, but also new risks. This leads to an important question for investors. Can we create a form of money that combines the strengths of the past without inheriting their weaknesses? A form of money that is scarce like gold, but easy to transfer like digital payments. A form of money that does not rely on trust in governments or banks. A form of money that is secure, transparent, and global. For a long time, this idea seemed impossible. Digital money existed before, but it always depended on a central authority. Someone had to verify transactions. Someone had to control the system. This created the same problems we have already seen. Control leads to manipulation. Manipulation leads to loss of trust. The challenge was clear. How do you create digital money without a central authority? How do you ensure scarcity in a digital world where copying is easy? How do you build trust without relying on institutions? These problems remained unsolved for decades. Until a breakthrough occurred. In 2008, a new idea was introduced. An idea that combined cryptography, economics, and network technology. An idea that changed the concept of money forever. This idea was Bitcoin. Bitcoin is not just another form of currency. It is a new monetary system. It removes the need for trust in central authorities. It replaces it with rules, mathematics, and decentralized verification. It creates scarcity in the digital world. It allows value to be transferred globally without intermediaries. For investors, this represents a major shift. Just as gold once replaced primitive money, Bitcoin has the potential to challenge modern fiat systems. But understanding Bitcoin is not easy at first. It introduces new concepts, new technology, new ways of thinking about value. If you approach it without understanding the basics, it may seem complex or risky. But if you build on the foundation we have covered, it becomes clearer. you begin to see how Bitcoin follows the same principles that have always defined strong money: scarcity, durability, portability, independence from control. Bitcoin is an attempt to bring these qualities into the digital age. It is the next step in the evolution of money. But before we explore its deeper aspects, we must start with the basics. We must answer a simple question. What is Bitcoin? Chapter 9. What is Bitcoin? Bitcoin is a new form of money. It exists entirely in digital form. It is not controlled by any government, bank, or company. At first, this idea may sound unusual. We are used to money being issued by central authorities. We trust banks to store it in. We trust governments to manage it. Bitcoin works differently. It removes the need for trust in institutions. Instead, it relies on rules, mathematics, and a decentralized network. In simple terms, Bitcoin is a digital currency that operates on a system called blockchain. This system records all transactions in a public ledger. Anyone can view it. Anyone can verify it. But no single person can control it. This is what makes Bitcoin unique. To understand Bitcoin better, think of it as a network of computers spread across the world. These computers work together to maintain the system. They verify transactions. They update records. They enforce rules. No central authority is needed. This is called decentralization. Decentralization means control is distributed. No single point of failure exists. No single entity can change the rules easily. This makes Bitcoin resistant to censorship and manipulation. Another important feature of Bitcoin is its fixed supply. There will only ever be 21 million Bitcoins. This limit is built into the system. It cannot be changed easily. This creates digital scarcity. Scarcity is what gives money value. Gold is valuable because it is hard to produce. Bitcoin is valuable because it is limited by design. New Bitcoins are created through a process called mining. Mining involves solving complex mathematical problems. Computers compete to solve these problems. The first to solve it gets rewarded with new Bitcoins. This process also secures the network. It ensures that transactions are valid. It prevents fraud and double spending. Double spending is a major problem in digital money. Since digital files can be copied, it is easy to spend the same unit twice. Bitcoin solves this problem through its network consensus. All participants agree on the state of transactions. Once a transaction is confirmed, it becomes part of the permanent record. This record cannot be easily altered. This creates trust without needing a central authority. For investors, this is a powerful concept. It means ownership is clear and verifiable. It means transactions cannot be reversed arbitrarily. It means rules are enforced consistently. Another important aspect of Bitcoin is ownership. When you own Bitcoin, you control it through private keys. A private key is like a password. It gives you access to your funds. If you hold your private keys, you fully control your money. No bank can freeze it. No authority can block it. This is known as self-custody. It gives individuals complete control over their wealth. But it also comes with responsibility. If you lose your private keys, you lose access to your Bitcoin. There is no recovery system. This is very different from traditional banking. In banks, you can reset your password. In Bitcoin, you must protect your keys carefully. Another feature of Bitcoin is transparency. All transactions are recorded publicly. Anyone can verify the history of the system. This creates a high level of trust, but identities are not directly linked to transactions. This provides a degree of privacy. Bitcoin is also borderless. You can send it anywhere in the world. There are no restrictions based on location. There are no banking hours. Transactions can happen at any time. This makes Bitcoin a global monetary system. For investors, this opens new possibilities. It allows access to a global market. It allows movement of value without intermediaries. Another key concept is that Bitcoin is programmable. Its rules are defined by code. These rules are transparent and predictable. They cannot be changed easily. Changes require agreement from the network. This creates stability. It ensures that no single party can alter the system for personal gain. Bitcoin also introduces a new way of thinking about trust. In traditional systems, trust is placed in institutions. In Bitcoin, trust is placed in the system itself, in its rules, in its transparency, in its decentralization. This shift is significant. It reduces reliance on human decision-making. It replaces it with automated enforcement. For investors, this reduces certain risks. It removes the uncertainty of policy changes. It removes the risk of arbitrary control, but it introduces new considerations: technology risk, security risk, adoption risk. Understanding these risks is important. Bitcoin is still evolving. Its price can be volatile. Its adoption is growing, but not universal. This creates both opportunity and uncertainty. Another important point is that Bitcoin is not just a currency. It is also a network. And like all networks, its value increases as more people use it. This is known as network effect. The more users it has, the more useful it becomes. This can lead to exponential growth, but it also means early stages can be unstable. For investors, timing and perspective are important. Short-term price movements can be unpredictable, but long-term value depends on adoption and utility. Bitcoin also challenges traditional financial systems. It offers an alternative to banking. It offers an alternative to fiat money. This creates resistance. Existing systems do not change easily. They adapt slowly. They protect their position. This means Bitcoin's journey is not smooth. It faces challenges: regulatory challenges, technical challenges, adoption challenges. But it also has strong advantages: scarcity, security, global accessibility. These qualities align with the principles of strong money. As an investor, your goal is not to follow trends blindly. It is to understand fundamentals. Bitcoin represents a new monetary model, one that combines technology with economic principles. To evaluate it properly, you must understand how it works, not just at a surface level, but at a deeper level. Because its design is what gives it strength, its structure is what creates trust, and its rules are what define its value. Now that we understand what Bitcoin is, the next step is to explore how it actually works, how transactions are processed, how the network stays secure, and how consensus is achieved without central control. Chapter 10. How Bitcoin Works. To understand Bitcoin deeply, you must understand how it works. At first, it may seem complex, but the core idea is simple. Bitcoin is a system that allows people to send and receive value without a central authority. It does this through a combination of technology and rules. The foundation of Bitcoin is something called the blockchain. The blockchain is a public record of all transactions. Think of it as a digital ledger. Every transaction ever made is recorded in this ledger. This ledger is shared across thousands of computers around the world. These computers are called nodes. Each node has a copy of the entire blockchain. This makes the system decentralized. No single entity controls the ledger. When someone sends Bitcoin, the transaction is broadcast to the network. Nodes receive this transaction. They check if it is valid. They verify that the sender has enough balance. They verify that the transaction follows the rules. Once verified, the transaction waits to be added to the blockchain. This is where miners come in. Miners are specialized participants in the network. They collect transactions and group them into blocks. A block is like a page in the ledger. Each block contains multiple transactions. Miners compete to add their block to the blockchain. They do this by solving a mathematical puzzle. This process is called proof of work. It requires computing power and energy. The first miner to solve the puzzle gets the right to add their block. When a block is added, it becomes part of the permanent record. The miner receives a reward in Bitcoin. This reward has two parts: newly created Bitcoins and transaction fees paid by users. This system creates incentives. Miners are rewarded for securing the network. They invest in hardware and energy to participate. This makes attacking the network expensive. Security in Bitcoin comes from this cost. To change a past transaction, an attacker would need to redo the work of many blocks. This would require massive resources, and even then, the network would likely reject it. This makes Bitcoin highly secure. Another key concept is consensus. Since there is no central authority, the network must agree on the state of the ledger. This agreement is called consensus. Bitcoin achieves consensus through its rules. All nodes follow the same protocol. They accept valid transactions. They reject invalid ones. If a miner tries to cheat, their block is rejected. This ensures that everyone follows the same rules. Consensus emerges naturally from this process. Another important feature is the linking of blocks. Each block contains a reference to the previous block. This creates a chain of blocks. If one block is changed, it affects all following blocks. This makes tampering extremely difficult. This structure is what gives the blockchain its name. It is a chain of blocks, connected and secured by cryptography. Cryptography plays a central role in Bitcoin. It ensures that transactions are secure. When you send Bitcoin, you use your private key to sign the transaction. This proves that you are the owner of the funds. Others can verify this using your public key, but they cannot access your private key. This system ensures both security and transparency. Another important aspect is transaction confirmation. When a transaction is included in a block, it is considered confirmed. Each new block added after that increases the level of confirmation. The more confirmations, the more secure the transaction becomes. For large transactions, multiple confirmations are usually required. This reduces the risk of reversal. Bitcoin also has a predictable issuance schedule. New Bitcoins are created as rewards for miners, but this reward decreases over time. This process is called halving. Approximately every 4 years, the reward is cut in half. This reduces the rate of new supply. Eventually, no new Bitcoins will be created. This ensures a fixed supply of 21 million coins. This predictability is a key feature. Unlike fiat money, where supply can change based on policy, Bitcoin supply is known in advance. For investors, this creates certainty. It allows long-term planning. It removes the risk of unexpected inflation from supply changes. Another important concept is difficulty adjustment. The network adjusts the difficulty of mining regularly. If more miners join, the difficulty increases. If miners leave, the difficulty decreases. This keeps block production consistent. Blocks are added roughly every 10 minutes. This stability is important for the system. It ensures predictable operation. Bitcoin also operates without downtime. The network runs continuously. There are no closing hours. Transactions can be made at any time. This makes Bitcoin highly reliable. Another feature is permissionless access. Anyone can join the network. You do not need approval. You do not need to trust a central authority. This creates openness. It allows global participation. But it also means users must take responsibility. There is no central support system. Security depends on individual actions. For investors, this requires awareness. You must understand how to store your Bitcoin safely. You must understand how transactions work. This reduces the risk of loss. Another key idea is that Bitcoin separates money from identity. Transactions are linked to addresses, not personal names. This provides a level of privacy, but it is not complete anonymity. All transactions are visible on the blockchain. This balance between transparency and privacy is unique. Bitcoin also removes intermediaries. In traditional systems, banks and payment processors are involved. They verify transactions. They maintain records. In Bitcoin, the network performs these functions. This reduces costs. It reduces delays. It reduces dependency on institutions. For investors, this changes the structure of finance. It creates a more direct system, but it also removes certain protections. There is no chargeback system. There is no central authority to resolve disputes. This makes understanding the system even more important. Bitcoin works because of its design. Each component supports the others. Decentralization prevents control. Proof of work ensures security. Consensus enforces rules. Scarcity preserves value. Together, they create a system that operates independently, a system that does not rely on trust in people, but on trust in rules and mathematics. For investors, this is a new paradigm. It requires a shift in thinking, from trusting institutions to understanding systems, from relying on authority to relying on transparency. Now that you understand how Bitcoin works, the next step is to examine its properties. What makes it strong? What makes it different? And why it is often compared to gold. Chapter 11. Bitcoin's Properties. To understand why Bitcoin matters, you must understand its properties. Money is not valuable by accident. It becomes valuable because it has certain qualities. Throughout history, the strongest forms of money shared similar characteristics: durability, portability, divisibility, scarcity, recognizability. Bitcoin was designed to match and improve these properties in the digital world. Let us explore them one by one. The first property is durability. Good money must last over time. Gold is durable because it does not decay or corrode. Bitcoin is even more durable in a digital sense. It exists as information on a global network. As long as the network exists, Bitcoin exists. It cannot be physically destroyed like cash or metals. This gives it a unique advantage. The second property is portability. Money should be easy to move. Gold is valuable, but it is heavy and difficult to transport. Bitcoin can be sent anywhere in the world within minutes. You can transfer large amounts without physical effort. This makes it highly efficient for global transactions. The third property is divisibility. Money should be divisible into smaller units. This allows flexibility in transactions. Bitcoin can be divided into very small units. The smallest unit is called a Satoshi. This makes it suitable for both large and small payments. The fourth property is recognizability. People must be able to verify money easily. Gold requires testing to confirm purity. Bitcoin transactions are verified by the network. The system ensures that all coins are genuine. This removes the need for manual verification. The fifth and most important property is scarcity. Scarcity is what protects value. If money can be created easily, it loses purchasing power. Bitcoin has a fixed supply of 21 million coins. This limit is built into its code. It cannot be changed easily. This creates absolute scarcity. Unlike gold, where new discoveries can increase supply, Bitcoin's supply is predictable and limited. This makes it one of the hardest forms of money ever created. Another important property is resistance to censorship. In traditional systems, transactions can be blocked. Banks can freeze accounts. Governments can restrict payments. Bitcoin does not allow this easily. Transactions are processed by a decentralized network. No single authority can stop them. This gives users financial freedom. Another key property is verifiability. Every transaction in Bitcoin can be checked. The entire history is public. Anyone can confirm that the system is working correctly. This level of transparency is rare in financial systems. It builds trust without relying on institutions. Bitcoin is also resistant to confiscation. If you control your private keys, your funds cannot be easily taken. There is no central authority that can access your account. This makes it attractive in uncertain environments. Another important property is programmability. Bitcoin operates on fixed rules. These rules are enforced by the network. They are transparent and predictable. This reduces uncertainty. Investors can rely on the system behaving consistently over time. Bitcoin also benefits from network effects. As more people use it, its value increases. More users mean more security. More adoption means more utility. This creates a positive feedback loop. But it also means early stages can be volatile. Another property is decentralization. Control is distributed across thousands of nodes. No single entity can dominate the network easily. This reduces the risk of manipulation. It creates resilience. Even if part of the network fails, the system continues to operate. Bitcoin also has a high stock-to-flow ratio. As discussed earlier, this measures scarcity. Bitcoin's supply grows slowly and predictably. Over time, new supply becomes smaller compared to existing supply. This strengthens its store of value characteristics. For investors, this is a key factor. Assets with high stock-to-flow tend to preserve value better. Another important aspect is neutrality. Bitcoin does not discriminate. Anyone can use it. It does not depend on identity, location, or status. This makes it globally accessible. It creates equal opportunity for participation. Bitcoin also reduces reliance on intermediaries. You do not need a bank to hold or transfer your funds. This reduces costs. It also reduces points of failure. However, these advantages come with responsibilities. Users must manage their own security. They must protect their private keys. They must understand the system. For investors, this requires education, but it also provides independence. Another important property is predictability. Bitcoin follows a fixed schedule. Supply increases at a known rate. Changes to the system require consensus. This makes it stable in terms of rules. Unlike fiat systems, where policies can change quickly, predictability reduces uncertainty. And uncertainty is a major risk in investing. Bitcoin also introduces digital scarcity for the first time. In the digital world, copying is easy. Files can be duplicated endlessly. Bitcoin solves this problem. It ensures that each unit is unique and cannot be copied. This is a major breakthrough. It allows digital value to behave like physical scarcity. For investors, this opens new possibilities. It creates a new asset class, one that combines the strengths of technology and economics. But it is important to remain balanced. Bitcoin has strong properties, but it is still evolving. It faces challenges. Adoption is not universal. Regulation is uncertain. Technology continues to develop. Understanding both strengths and risks is essential. Bitcoin's properties explain why it is often compared to gold. But it also goes beyond gold in many ways. It brings strong money into the digital age. Now that we understand these properties, the next step is to explore how they translate into economics, how Bitcoin behaves in markets, how value is created and stored, and how it fits into the broader financial system. Chapter 12. Bitcoin Economics. To understand Bitcoin as an investment, you must understand its economics. Economics explains how value is created, stored, and exchanged. Bitcoin introduces a new economic model, one that is different from traditional systems. The most important concept in Bitcoin economics is supply. Bitcoin has a fixed maximum supply of 21 million coins. This limit is not a suggestion. It is a rule built into the system. No central authority can change it easily. This makes Bitcoin fundamentally different from fiat money. In fiat systems, supply can increase without limit. Central banks can print money whenever they choose. This reduces the value of existing money over time. Bitcoin does the opposite. Its supply is limited and predictable. New Bitcoins are created through mining. But the rate of creation decreases over time. This process is called halving. Approximately every 4 years, the reward for mining is reduced. This slows down the rate of new supply. Eventually, no new Bitcoins will be created. This creates a deflationary system. In a deflationary system, the value of money tends to increase over time, because supply is fixed and demand can grow. For investors, this creates a unique dynamic. Instead of losing value, money may gain value. This encourages saving. It encourages long-term thinking. This aligns with low-time preference behavior. Another key concept is demand. Bitcoin's value depends on how many people want to use it. As adoption increases, demand increases. If supply is fixed and demand rises, price increases. This is basic economic logic. Bitcoin adoption has been growing over time. Individuals, businesses, and institutions are starting to use it. This increases its network effect. The more people use Bitcoin, the more valuable it becomes. This creates a feedback loop. Higher value attracts more users. More users increase value further, but this process is not smooth. Bitcoin is highly volatile. Prices can rise quickly and fall sharply. This volatility is a result of its early stage. Markets are still discovering its value. Liquidity is still developing. For investors, volatility can be challenging, but it also creates opportunity. Those who understand the long-term potential can benefit. Another important concept is cost of production. Bitcoin requires energy and computing power to mine. This creates a real cost. Miners must spend resources to produce new Bitcoins. This cost acts as a foundation for value. It is similar to gold mining. Gold has value partly because it is expensive to produce. Bitcoin follows a similar principle. Another key idea is stock-to-flow ratio. As discussed earlier, this measures scarcity. Bitcoin has a high and increasing stock-to-flow ratio. As new supply decreases, scarcity increases. This strengthens its position as a store of value. For investors, this is a critical factor. Assets with high scarcity tend to perform well over time. Bitcoin also introduces the concept of digital property. Ownership is defined by control of private keys. This creates clear and enforceable ownership, without relying on legal systems. This is a new form of property rights. It operates globally. It is independent of local jurisdictions. This increases its appeal in uncertain environments. Another important aspect is monetary premium. Assets like gold and Bitcoin have value beyond their utility. They are valued because they are used as money. This additional value is called monetary premium. As Bitcoin adoption grows, its monetary premium may increase. This can significantly impact its price. Bitcoin also competes with other assets. It competes with gold as a store of value. It competes with fiat currencies as a medium of exchange. It competes with financial assets as an investment. This competition shapes its growth. For investors, understanding this competition is important. It helps you evaluate Bitcoin's potential. Another key factor is liquidity. Liquidity refers to how easily an asset can be bought or sold. Bitcoin liquidity has been increasing over time. More exchanges, more participants, more trading volume. This makes it easier to enter and exit positions. But liquidity can still vary. During market stress, price movements can be extreme. This adds risk. Another important concept is decentralization of supply. Bitcoin distribution is spread across many participants. No single entity controls the majority. This reduces the risk of manipulation. It creates a more balanced system. However, distribution is not perfectly equal. Early adopters hold significant amounts. This is something investors must consider. Another factor is regulation. Governments are still developing policies around Bitcoin. Some support it, some restrict it. Regulation can impact adoption. It can influence price movements. For investors, staying informed is important. Bitcoin also interacts with macroeconomic conditions. During inflation, interest in Bitcoin may increase. During financial instability, demand may rise. It is often seen as a hedge against monetary uncertainty. But this role is still evolving. Another key idea is long-term adoption curve. New technologies often follow a pattern. Slow adoption at first, then rapid growth, then maturity. Bitcoin appears to be in the growth phase. Understanding this helps investors maintain perspective. Short-term volatility does not define long-term value. Another important point is that Bitcoin rewards patience. Because of its design, value tends to build over time. Those who hold through volatility may benefit the most. This aligns with low-time preference investing. Discipline becomes essential. Emotional decisions can lead to losses. Understanding fundamentals helps maintain confidence. Bitcoin economics also challenges traditional thinking. In fiat systems, inflation is normal. In Bitcoin, scarcity is the norm. This changes incentives. It changes how people save and invest. It may lead to a shift in global financial behavior. For investors, this shift represents both opportunity and uncertainty. It requires careful analysis. It requires long-term thinking. It requires understanding both risks and rewards. Bitcoin is not guaranteed success. But its economic design is strong. It addresses many weaknesses of traditional systems. It introduces a new way of thinking about money and value. Now that we understand Bitcoin's economic foundation, the next step is to explore its real-world use, how it is applied. where it creates value, and how it fits into everyday life. Chapter 13. Bitcoin's Applications. After understanding what Bitcoin is, how it works, and its economic design, the next question is practical. Where is Bitcoin actually used? How does it create value in the real world? For investors, this is critical, because long-term value depends on real use, not just theory. Bitcoin has several key applications. Each of them solves a problem that exists in traditional financial systems. The first and most important application is store of value. Bitcoin is often compared to gold. It is scarce. It is durable. It is independent of central control. These qualities make it suitable for preserving wealth over time. In countries with stable currencies, this may seem less important. But in many parts of the world, currencies lose value quickly. Inflation can destroy savings. In such environments, Bitcoin offers an alternative. People can store value in a form that is not controlled by local governments. This protects purchasing power. For investors, this is one of the strongest use cases. Bitcoin acts as digital gold. It provides a hedge against inflation and monetary instability. The second application is global payments. Traditional international transfers are slow and expensive. Banks and intermediaries charge fees. Transactions can take days to settle. Bitcoin allows direct transfers between individuals. You can send value anywhere in the world, without relying on banks, without long delays. This reduces cost and increases efficiency. For businesses, this opens new opportunities. For individuals, it provides financial freedom. The third application is financial inclusion. Millions of people do not have access to banking services. They cannot open accounts. They cannot send or receive money easily. Bitcoin changes this. Anyone with internet access can use it. No permission is required. This creates access to a global financial system. It empowers individuals. It allows participation in the economy. Another important application is protection against censorship. In some systems, financial transactions can be restricted. Accounts can be frozen. Payments can be blocked. Bitcoin reduces this risk. Transactions are processed by a decentralized network. They cannot be easily stopped. This is important for individuals and businesses operating in uncertain environments. It ensures that value can move freely. Another use case is remittances. Many people send money to family members in other countries. Traditional remittance services charge high fees. Bitcoin can reduce these costs. It allows direct transfer without intermediaries. This increases the amount received by the recipient. For investors, this represents a large market. Global remittances are significant in size. Even partial adoption can have a major impact. Another application is as a settlement layer. Bitcoin can act as a base layer for financial systems. Large transactions can be settled securely on the network. This reduces reliance on traditional clearing systems. It increases transparency. It reduces counterparty risk. Another important use is as collateral. Bitcoin can be used as an asset in financial systems. It can support loans. It can be used in decentralized finance applications. This expands its role beyond simple transactions. For investors, this adds utility. It increases demand. Another emerging application is savings technology. In unstable economies, saving in local currency can be risky. Bitcoin provides an alternative. People can store value digitally. They can protect their wealth from inflation. This is already happening in several regions. Another use case is micropayments. Because Bitcoin is divisible, it can support very small transactions. This opens new business models. Content creators can receive small payments directly. Services can be paid for in tiny amounts. This was not practical in traditional systems. Bitcoin enables it. Another important application is sovereignty over wealth. In traditional systems, your money is held by institutions. You depend on them for access. With Bitcoin, you can hold your own wealth. You control it directly. This is known as financial sovereignty. For investors, this changes risk management. It reduces dependence on third parties. but it also requires responsibility. Security becomes your own responsibility. Another application is digital ownership. Bitcoin represents a new form of property. It is global. It is verifiable. It is independent of borders. This creates new possibilities. It allows people to store and transfer value without restrictions. Another important aspect is its role in times of crisis. During economic instability, access to money can be limited. Banks may close. Withdrawals may be restricted. Bitcoin continues to operate. It is available at all times. This reliability can be critical. For investors, this adds resilience to a portfolio. Another application is diversification. Bitcoin behaves differently from traditional assets. It is not directly tied to stocks or real estate. This makes it useful for diversification. Adding Bitcoin can reduce overall portfolio risk in some cases. But it also introduces volatility. Balance is important. Another emerging area is integration with technology. Bitcoin can be combined with other systems. It can be used in digital platforms. It can support new financial services. This expands its potential over time. However, it is important to remain realistic. Bitcoin is not a solution for everything. It has limitations. Transaction speed can be slower compared to some systems. Fees can vary depending on demand. User experience can be complex for beginners. Adoption is still growing. These challenges must be considered. For investors, understanding both strengths and weaknesses is essential. Applications create demand. Demand drives value. The more useful Bitcoin becomes, the stronger its position. But adoption takes time. It requires education. It requires infrastructure. It requires trust in the system. This process is ongoing. As an investor, your role is to observe these developments, to understand where value is being created, to identify long-term trends. Bitcoin's applications show that it is more than a theoretical concept. It is a working system with real-world use. It solves real problems. It creates new opportunities. Now that we understand how Bitcoin is used, the next step is to examine its practical challenges. Can it scale to global demand? Can it compete with other cryptocurrencies? And how does it fit into the existing financial system? Part 3. Bitcoin in practice. So far, we have explored the theory behind money. We have understood the evolution of monetary systems, and we have examined Bitcoin as a new form of money. Now, it is time to move from theory to reality. Because for investors, ideas alone are not enough. What matters is how these ideas perform in the real world. Bitcoin is not just a concept. It is a live system. It operates every day. It processes transactions. It interacts with global markets. But like any system, it faces challenges. Strong ideas must survive real-world conditions. They must handle scale. They must compete with alternatives. They must adapt to changing environments. This is where many innovations fail. They work well in theory, but struggle in practice. For Bitcoin, the questions are clear. Can it handle global demand? Can it process millions of transactions efficiently? Can it compete with other cryptocurrencies? Can it integrate with existing financial systems? Can it maintain its core principles while growing? These are not simple questions. They require careful analysis. They require understanding both technology and economics. For investors, this stage is critical because it determines long-term viability. An asset may have strong fundamentals, but if it cannot function in practice, its value is limited. At the same time, challenges create opportunity. Systems that overcome difficulties become stronger. They gain trust. They gain adoption. Bitcoin has already faced many challenges: technical limitations, market volatility, regulatory pressure, and yet it continues to operate and grow. This resilience is important. It shows that the system is not fragile. It can adapt while maintaining its core structure. Another important point is competition. Bitcoin is not alone. There are thousands of alternative cryptocurrencies. Each claims to improve on Bitcoin. Some focus on speed. Some focus on privacy. Some focus on new features. But competition is part of any market. It drives innovation. It forces systems to improve. For investors, understanding competition is essential. It helps you evaluate risk. It helps you identify which systems have long-term potential. Another key factor is integration with traditional finance. Bitcoin does not exist in isolation. It interacts with banks, markets, and institutions. This creates both opportunities and challenges. Integration can increase adoption, but it can also introduce regulation and control. Balancing independence and integration is complex. Bitcoin must maintain its core principles, while also becoming useful in the broader economy. For investors, this balance is important. Too much control reduces its value proposition. Too little integration limits its adoption. Another important aspect is perception. Public understanding of Bitcoin is still evolving. Some see it as an opportunity. Others see it as a risk. This affects adoption. It affects price. Education plays a key role here. As more people understand Bitcoin, its position may strengthen. For investors, this creates a long-term trend to watch. Another factor is time. Adoption does not happen overnight. It follows a gradual process. Early adopters take the first step, then early majority follows, then broader acceptance develops. Bitcoin appears to be moving through this process. Understanding where we are in this cycle helps investors make better decisions. This part of the journey is about reality. It is about testing ideas against real-world conditions. It is about understanding strengths and weaknesses. It is about evaluating long-term sustainability. As we move forward, we will examine specific challenges and opportunities. We will look at scalability. We will analyze competition. We will explore the relationship with banking, and we will evaluate Bitcoin as an investment. Each of these topics brings us closer to a complete understanding, because in the end, investors must answer one question. Is Bitcoin a temporary trend, or a lasting transformation? To begin answering that, we start with a key issue. Can Bitcoin scale? Chapter 14. Can Bitcoin scale? As Bitcoin grows in popularity, one question becomes more important. Can it handle global demand? Can it support millions or even billions of users? This question is critical for investors, because scalability determines long-term success. A system that cannot scale cannot become global money. To understand this, we must first look at how Bitcoin currently operates. Bitcoin processes transactions in blocks. Each block is added approximately every 10 minutes. There is a limit to how many transactions each block can contain. This creates a natural limit on transaction capacity. Compared to traditional payment systems, Bitcoin is slower. Systems like credit card networks can process thousands of transactions per second. Bitcoin processes far fewer at the base layer. At first, this seems like a weakness, but this limitation is intentional. Bitcoin prioritizes security and decentralization over speed. If blocks were too large, fewer people could run nodes. This would reduce decentralization, and decentralization is one of Bitcoin's core strengths. For investors, this trade-off is important. Bitcoin is designed to be secure first, efficient second. This creates a strong foundation, but it also raises the question of scaling. How can Bitcoin handle more users without compromising its core principles? The answer lies in layers. Bitcoin is often compared to the internet. The internet also has layers. The base layer handles fundamental communication. Higher layers handle applications like websites and messaging. Bitcoin follows a similar approach. The base layer is the blockchain. It is highly secure. It is decentralized. It is reliable. But it is not designed for high-speed transactions. To solve this, additional layers are built on top. One of the most important solutions is the Lightning Network. The Lightning Network is a second-layer system. It allows users to create payment channels. Within these channels, transactions can happen instantly and at very low cost. These transactions do not need to be recorded on the blockchain immediately. Only the final result is settled on the base layer. This reduces congestion, it increases speed, it lowers fees. For investors, this is a key development. It shows that Bitcoin can evolve without changing its core structure. It can scale through innovation. Another approach to scaling is batching transactions. Exchanges and large users can group multiple transactions into one. This reduces the number of entries on the blockchain. It increases efficiency. Another method is improving software and optimization. Developers continuously work to make the system more efficient. Small improvements can have large effects over time. Another concept is sidechains. Sidechains are separate blockchains connected to Bitcoin. They allow experimentation with new features without changing the main network. This creates flexibility. It allows innovation without risking the core system. However, scalability is not just about technology. It is also about user behavior. Not every transaction needs to happen on the base layer. Large transactions and final settlements can use the blockchain. Smaller, everyday transactions can use second-layer solutions. This layered approach mirrors traditional finance. Central banks settle large transactions, while everyday payments happen through different systems. Bitcoin can follow a similar structure. Another important factor is demand. As more people use Bitcoin, competition for block space increases. This leads to higher transaction fees. Higher fees can limit small transactions, but they also serve a purpose. They prioritize important transactions. They ensure that the network remains secure. For investors, fees are a signal. They reflect demand for the network. High demand indicates strong usage, but it also highlights the need for scaling solutions. Another challenge is user experience. For Bitcoin to scale globally, it must be easy to use. Complex systems slow adoption. Users need simple interfaces. They need reliable tools. They need education. Improving user experience is as important as improving technology. Another aspect is infrastructure. Exchanges, wallets, and payment services must support growth. They must handle large volumes. They must remain secure. Infrastructure development is a key part of scaling. Another consideration is energy use. Bitcoin mining requires energy. As the network grows, this becomes a topic of discussion. Some see it as a cost, others see it as a feature. Energy use secures the network. It makes attacks expensive. For investors, understanding this trade-off is important. Security often comes with cost, and strong systems require investment. Another challenge is global adoption. Different regions have different regulations, different levels of technological access, different economic conditions. Scaling must account for these differences. Bitcoin must be accessible to diverse populations. This requires flexible solutions. Another key point is that scaling is not a single event. It is an ongoing process. As demand grows, new solutions are developed. As technology improves, efficiency increases. This is similar to the growth of the internet. Early internet was slow and limited. Over time, it became fast and widely accessible. Bitcoin may follow a similar path. For investors, patience is essential. Early-stage technologies often appear limited, but they improve over time. Those who understand this can see beyond current limitations. Another important perspective is that not all scaling needs to happen on-chain. Bitcoin does not need to process every transaction directly. It needs to serve as a secure foundation. Other systems can build on top of it. This allows it to scale without losing its core properties. Another factor is competition. Some alternative cryptocurrencies focus on speed. They process more transactions at the base layer, but they often sacrifice decentralization or security. Bitcoin chooses a different path. It prioritizes long-term strength over short-term speed. For investors, this difference is crucial. Fast systems may grow quickly, but strong systems tend to last longer. Another consideration is economic scaling. As Bitcoin grows in value, fewer transactions are needed for large transfers. High-value transactions become more efficient. This changes how the network is used. It becomes more like a settlement layer, while smaller transactions move to higher layers. This evolution is natural. It aligns with the structure of mature financial systems. Bitcoin scaling is not about making it identical to existing systems. It is about creating a new system that works differently. A system that balances security, decentralization, and efficiency. For investors, this balance is key. It determines long-term sustainability. It determines whether Bitcoin can fulfill its potential. The question is not whether Bitcoin can scale perfectly today. The question is whether it can evolve to meet future demand. So far, the answer appears promising. Solutions are being developed. Adoption is increasing. The system continues to operate reliably. Challenges remain, but progress is ongoing. Understanding this helps investors maintain perspective. Short-term limitations do not define long-term potential. Scalability is a journey, not a destination. Now that we understand the challenges of scaling, the next step is to examine competition. How does Bitcoin compare to other cryptocurrencies? Can alternatives replace it? Or does it have unique advantages? Chapter 15. Competition from Altcoins. As Bitcoin gained attention, many other digital currencies began to appear. These are commonly called altcoins. The term simply means alternatives to Bitcoin. Today, there are thousands of them. Each claims to improve on Bitcoin in some way. Some promise faster transactions. Some promise lower fees. Some offer additional features. At first glance, this may seem like strong competition. For investors, this creates an important question. Is Bitcoin just one option among many? Or does it have a unique position? To answer this, we must understand the nature of competition in money. Money is not like other products. In most markets, multiple products can succeed. Different companies can offer similar services. But money tends to follow a different pattern. It usually converges toward a dominant standard. This happens because of network effects. The more people use a form of money, the more useful it becomes. People prefer to use the same money as others. This creates a strong advantage for the leading system. Historically, gold became dominant for this reason. It was widely accepted. It was trusted. Once it reached a critical level of adoption, it became very difficult to replace. Bitcoin may be following a similar path. It was the first successful decentralized digital currency. It has the largest network, the most users, the highest security. This gives it a strong position. Altcoins attempt to compete by offering improvements, but these improvements often involve trade-offs. For example, faster transaction speeds may require more centralization. Lower fees may come at the cost of reduced security. Additional features may increase complexity. These trade-offs are important because they affect the core properties of money: security, decentralization, scarcity. If these properties are weakened, the system becomes less reliable. For investors, understanding these trade-offs is essential. Not all improvements are beneficial. Some may create hidden risks. Another important factor is security. Bitcoin has the most secure network among cryptocurrencies. It has the largest amount of computing power protecting it. This makes it very difficult to attack. Altcoins generally have lower security. Their networks are smaller. They are easier to manipulate. For money, security is critical. Without security, value cannot be trusted. Another key point is decentralization. Bitcoin is highly decentralized. Control is distributed across many participants. No single entity can easily control the system. Some altcoins are more centralized. They may have small groups of developers controlling decisions. They may have pre-mined coins concentrated in few hands. This creates risk. Centralization can lead to manipulation. It can lead to changes in rules. For investors, this reduces reliability. Another important aspect is immutability. Bitcoin's rules are difficult to change. Changes require broad consensus across the network. This protects the system from sudden shifts. Some altcoins change frequently. They update rules quickly. While this may allow innovation, it also creates uncertainty. Investors may face unexpected changes. Predictability is important for long-term value. Another factor is credibility. Bitcoin has been operating since its creation without major failure. It has built a track record. It has survived market cycles. It has survived criticism and challenges. This history builds trust. Most altcoins do not have this track record. Many have appeared and disappeared over time. Some were abandoned, some failed technically, some lost community support. For investors, this creates risk. New projects may look promising, but long-term survival is uncertain. Another important concept is monetary policy. Bitcoin has a fixed supply. Its rules are clear and predictable. Many altcoins have flexible supply. They can increase or change supply based on decisions. This reduces scarcity. It weakens their ability to store value. For money, strong monetary policy is essential. Without it, long-term value is uncertain. Another key idea is branding and perception. Bitcoin is widely recognized. It is often seen as the original and most trusted cryptocurrency. This gives it a strong psychological advantage. People associate Bitcoin with digital money. Altcoins must compete with this perception. This is difficult to overcome. Another factor is innovation. Altcoins often experiment with new ideas. They test new features. They explore new technologies. This can be valuable. Some innovations may eventually be adopted by Bitcoin. Bitcoin evolves slowly and carefully. It prioritizes stability over rapid change. For investors, this creates a distinction. Bitcoin is conservative and secure. Altcoins are experimental and dynamic. Both have roles, but their risk profiles are very different. Another important aspect is market behavior. Altcoins often experience rapid price increases. They attract attention during bull markets, but they can also decline sharply. Many lose value over time. Bitcoin tends to be more resilient. It still experiences volatility, but it has shown stronger long-term performance. For investors, this highlights the importance of risk management. Chasing quick gains can be tempting, but it often leads to losses. Understanding fundamentals helps avoid this. Another key point is that not all altcoins are the same. Some focus on specific use cases. Some aim to solve particular problems, but very few aim to replace Bitcoin as money. Bitcoin's primary role is as a store of value and monetary network. Most altcoins focus on other areas. This reduces direct competition. Another important concept is survivorship. Over time, weaker systems tend to disappear. Stronger systems remain. This process takes time, but it clarifies the market. Bitcoin has already survived multiple cycles. This strengthens its position. For investors, patience is important. It allows trends to become clear. It reduces the impact of short-term noise. In conclusion, altcoins provide competition and innovation, but they also introduce risk. Bitcoin remains unique because of its security, decentralization, and scarcity. It has a strong network effect. It has a proven track record. For investors, the key is not to follow hype, but to understand fundamentals, to evaluate long-term potential, and to manage risk carefully. Now that we have explored competition, the next step is to examine how Bitcoin interacts with traditional financial systems, how it relates to banks, and how it may change the role of financial institutions. Chapter 16: Bitcoin and Banking. To understand Bitcoin's full impact, we must examine its relationship with banking. Banks are central to the modern financial system. They store money, they process payments, they provide credit. Most people interact with money through banks, but Bitcoin introduces a different model, a model that reduces the need for traditional intermediaries. This creates both disruption and opportunity. In the traditional system, banks act as custodians. They hold your money on your behalf. You trust them to keep it safe. You trust them to process your transactions. But this trust comes with trade-offs. Banks can restrict access. They can freeze accounts. They can limit transactions. In extreme cases, they can fail. Bitcoin changes this relationship. With Bitcoin, you can hold your own money. You control it through private keys. There is no need for a custodian. This is called self-custody. It gives individuals full control over their wealth. For investors, this is a major shift. It reduces counterparty risk. You are not dependent on a bank's stability. You are not exposed to bank policies, but it also introduces responsibility. You must secure your own assets. You must manage your own access. There is no safety net. This balance between control and responsibility is important. Another key difference is in payments. Banks process transactions through centralized systems. These systems can be slow and expensive. International transfers can take days. Fees can be significant. Bitcoin offers an alternative. Transactions are processed by a decentralized network. They can be faster and more efficient. They do not require intermediaries. This reduces cost and complexity. For businesses, this can improve efficiency. For individuals, it increases financial freedom. Another important aspect is settlement. In banking, transactions often involve multiple layers. Payments go through clearinghouses and intermediaries. Final settlement can take time. Bitcoin simplifies this process. Transactions settle directly on the network. Once confirmed, they are final. This reduces counterparty risk. It increases transparency. For investors, this creates a more direct system. Another key function of banks is lending. Banks provide credit to individuals and businesses. They create loans based on deposits. This expands the money supply. Bitcoin operates differently. It does not rely on fractional reserve lending. Its supply is fixed. This changes how credit works. In a Bitcoin-based system, lending would need to be backed by real savings. This could lead to more disciplined lending practices. It could reduce excessive debt, but it may also limit credit availability. This is a complex trade-off. Another important factor is financial stability. Banks play a role in managing economic cycles. Central banks adjust interest rates. They influence borrowing and spending. Bitcoin does not have this mechanism. Its supply is fixed. It does not respond to economic conditions. This creates a different type of system, one that is less flexible but more predictable. For investors, this means fewer artificial interventions, but also fewer safety mechanisms. Another aspect is regulation. Banks operate under strict regulations. They must follow rules set by governments. Bitcoin operates outside this framework. It is decentralized and global. This creates challenges for regulation. Governments may try to control access points, such as exchanges and payment services, but they cannot easily control the network itself. For investors, regulation is an important factor. It can influence adoption. It can affect market behavior. Staying informed is essential. Another key point is integration. Bitcoin is not completely separate from banking. Many banks and financial institutions are exploring it. Some offer custody services. Some support trading. Some are building infrastructure around it. This creates a bridge between systems. Integration can increase adoption, but it also introduces new dynamics. Banks may try to adapt Bitcoin to existing frameworks. This could change how it is used. For investors, understanding this interaction is important. It helps you see where value is being created. Another important concept is trust. Banks rely on trust in institutions. Bitcoin relies on trust in code and mathematics. This is a fundamental difference. Institutional trust can be broken. Rules can change. Policies can shift. Bitcoin's rules are more stable. They require consensus to change. This creates a different kind of reliability. Another aspect is accessibility. Banks require identification and approval. Not everyone can access their services. Bitcoin is open to anyone with internet access. This increases financial inclusion. It allows global participation. For investors, this expands the potential user base. Another key factor is crisis response. In times of financial stress, banks may restrict withdrawals. Governments may impose controls. Bitcoin continues to operate. It remains accessible. This makes it valuable in uncertain conditions. Another important point is cost structure. Banking systems involve overhead, branches, staff, infrastructure. Bitcoin operates digitally. This can reduce costs over time, but it also shifts costs to users. Users must manage security. Users must understand the system. This creates a different cost balance. For investors, this is part of the evaluation. Efficiency versus responsibility. Another concept is competition. Bitcoin does not necessarily replace banks completely. It competes in certain areas. Store of value, payments, settlement. Banks may continue to exist, but their role may change. They may focus more on services rather than control of money. This evolution is ongoing. For investors, it creates opportunities. New business models may emerge. New services may develop. Understanding these trends helps identify value. In conclusion, Bitcoin challenges the traditional banking system. It offers an alternative model, one based on decentralization and individual control. It reduces reliance on intermediaries. It increases transparency and accessibility. But it also introduces new responsibilities and risks. For investors, the key is balance, understanding both systems, recognizing their strengths and weaknesses, and positioning accordingly. Now that we understand Bitcoin's relationship with banking, the next step is to evaluate it directly as an investment. How it fits into a portfolio, what risks it carries, and what potential it offers. Chapter 17. Bitcoin as an investment. After understanding Bitcoin's technology, properties, and real-world use, the next step is clear. How should an investor view Bitcoin? Is it a speculation? Is it a store of value? Or is it something entirely new? The answer is not simple. Bitcoin is a unique asset. It does not fit neatly into traditional categories. It shares characteristics with several asset classes. Like gold, it acts as a store of value. Like technology, it benefits from network growth. Like commodities, it has a cost of production. This combination makes it different. For investors, this creates both opportunity and complexity. The first thing to understand is volatility. Bitcoin is highly volatile. Prices can rise rapidly and fall just as quickly. This can be uncomfortable, especially for new investors, but volatility is not always negative. It reflects uncertainty and growth. In early stages, markets are still discovering value. As adoption increases, volatility may decrease over time. For investors, managing volatility is essential. Position size should be carefully considered. Emotional decisions should be avoided. Another key concept is time horizon. Bitcoin tends to reward long-term thinking. Short-term movements are unpredictable, but long-term trends are driven by fundamentals. Adoption, scarcity, network effect. Investors who focus on these factors are more likely to succeed. Another important point is risk. Bitcoin carries several types of risk. Market risk. Price fluctuations can be extreme. Technology risk. The system may face unforeseen challenges. Regulatory risk. Governments may introduce new rules. Adoption risk. Growth may be slower than expected. Understanding these risks is critical. They must be weighed against potential rewards. Another important factor is asymmetry. Bitcoin offers asymmetric returns. This means potential upside may be much larger than downside. For example, a small allocation could grow significantly if adoption increases. But losses are limited to the amount invested. This makes Bitcoin attractive for certain strategies. Another key idea is portfolio diversification. Bitcoin behaves differently from traditional assets. It is not strongly correlated with stocks or bonds. This makes it useful for diversification. Adding Bitcoin can improve risk-adjusted returns in some cases. But balance is important. Overexposure increases risk. Another important concept is conviction. Because Bitcoin is volatile, conviction matters. Without understanding, investors may panic during downturns. They may sell at the worst time. Understanding fundamentals helps maintain confidence. It allows you to stay disciplined. Another factor is liquidity. Bitcoin markets operate continuously. You can buy and sell at any time. This provides flexibility, but it also increases temptation to trade frequently. Frequent trading often leads to poor results. Long-term strategies tend to perform better. Another important idea is accumulation. Some investors use a strategy called dollar-cost averaging. They invest a fixed amount regularly. This reduces the impact of price volatility. It builds a position over time. This approach aligns with long-term thinking. Another key point is storage. How you store Bitcoin is critical. Holding on exchanges introduces risk. Exchanges can be hacked. Accounts can be restricted. Self-custody reduces these risks, but it requires knowledge and discipline. For investors, security is part of the investment process. Another important aspect is market cycles. Bitcoin has experienced multiple cycles. Periods of rapid growth followed by corrections. These cycles can be intense. Understanding them helps manage expectations. It helps avoid emotional reactions. Another concept is narrative. Market perception influences price. Stories about Bitcoin change over time. At times, it is seen as a risk. At times, as a safe haven. At times, as a technology play. These narratives affect demand. For investors, separating narrative from fundamentals is important. Another key factor is institutional adoption. Large investors and institutions are entering the market. This increases credibility. It increases liquidity. It may reduce volatility over time, but it also introduces new dynamics. Institutional behavior can influence markets differently. Another important point is comparison with gold. Bitcoin is often called digital gold. Both are scarce. Both are stores of value. But Bitcoin has advantages. It is easier to transport. It is easier to verify. It is more divisible. This comparison helps investors understand its role. Another concept is opportunity cost. Investing in Bitcoin means allocating capital that could be used elsewhere. This must be considered. Is the potential return worth the risk? Does it fit your strategy? These are important questions. Another key idea is discipline. Successful investing requires discipline. This is especially true with Bitcoin. Emotions can be strong. Price movements can create fear and excitement. Staying focused on long-term goals is essential. Another important factor is education. Bitcoin is complex. Understanding it takes time. But this effort creates advantage. Most people do not take the time to learn. Those who do can make better decisions. Another aspect is global impact. Bitcoin operates globally. It is not tied to a single economy. This creates unique opportunities. It also exposes it to global risks. Understanding global trends is important. Another key point is that Bitcoin is still evolving. Its role is not fully defined. It may become a global reserve asset. It may remain a niche investment. It may develop in unexpected ways. For investors, flexibility is important. Being open to change helps adapt to new information. In conclusion, Bitcoin as an investment is both promising and challenging. It offers strong potential due to its design and adoption. But it also carries significant risk. Success depends on understanding, discipline, and long-term thinking. It is not a guaranteed path to wealth, but it is an opportunity to participate in a new monetary system. Now that we have examined Bitcoin as an investment, the final step is to look ahead. What does the future hold? How might Bitcoin evolve? And what should investors expect in the long term? Chapter 18. The Future of Bitcoin. The future of Bitcoin is one of the most important and most debated topics in modern finance. For investors, it represents both opportunity and uncertainty. Bitcoin is still young compared to traditional systems. It has existed for only a short period in financial history. Yet in this short time, it has grown from an unknown experiment into a global asset. This rapid growth raises an important question. What happens next? Will Bitcoin continue to grow and become a global standard? Or will it face challenges that limit its adoption? To answer this, we must look at several key factors. The first factor is adoption. Adoption is the foundation of Bitcoin's future. The more people use it, the stronger it becomes. Adoption happens in stages. At first, only a small group of early adopters participate. These are people who understand the technology and see its potential. Then awareness begins to spread. More individuals start to explore it. Businesses begin to accept it. Institutions begin to invest in it. This process is already underway. Bitcoin has moved beyond the early stage. It is now in a phase of expanding adoption. More investors are entering the market. More infrastructure is being built. More awareness is being created. But global adoption is still far from complete. Billions of people have not yet used Bitcoin. This creates both opportunity and uncertainty. If adoption continues to grow, demand will increase. With a fixed supply, this could drive long-term value. The second factor is regulation. Governments play a major role in financial systems. Their response to Bitcoin will shape its future. Some governments support Bitcoin. They see it as innovation. They create policies that encourage growth. Other governments are more cautious. They see risks related to control and stability. They may introduce restrictions. They may attempt to regulate access points. This creates a complex environment. Bitcoin itself is difficult to control, but the systems around it can be influenced. For investors, regulation is an important factor to watch. It can create short-term volatility. It can influence long-term adoption. Another key factor is technological development. Bitcoin is not static. It continues to evolve. Developers work on improving efficiency. They work on improving scalability. They work on improving user experience. Second-layer solutions are expanding. These solutions allow faster and cheaper transactions. They make Bitcoin more practical for everyday use. Over time, these improvements can increase adoption. Another important area is security. Bitcoin's security is one of its strongest features. It is protected by a global network of miners. It is secured by energy and computation. As the network grows, security increases. But threats also evolve. Technology changes. New risks may emerge. Maintaining security is an ongoing process. For investors, this is critical. Security is the foundation of trust. Without trust, value cannot be sustained. Another key factor is competition. Bitcoin does not exist in isolation. Other cryptocurrencies continue to develop. Traditional financial systems continue to evolve. Central banks are exploring digital currencies. These systems may compete with Bitcoin in certain areas, but they also highlight its importance. They show that the idea of digital money is growing. Bitcoin's advantage lies in its decentralization and scarcity. These qualities are difficult to replicate. Another important factor is macroeconomic conditions. Global economic trends influence Bitcoin. Inflation increases interest in scarce assets. Economic instability increases demand for alternatives. Currency devaluation pushes people towards stronger stores of value. Bitcoin is positioned within these trends. As global conditions change, its role may become more significant. Another key concept is network effect. Bitcoin's value increases as more people use it. More users create more demand. More demand increases value. Higher value attracts more users. This cycle strengthens the network. Over time, this can create a dominant position. But network effects take time to develop fully. Patience is required. Another important factor is perception. Public perception of Bitcoin is still evolving. Some see it as risky. Some see it as revolutionary. Media coverage influences this perception. Market cycles influence sentiment. As understanding improves, perception may shift. This can impact adoption. Another key aspect is institutional involvement. Large institutions are entering the Bitcoin space. They bring capital. They bring credibility. They bring infrastructure. This can accelerate adoption, but it also introduces new dynamics. Institutional behavior can influence markets differently. For investors, this adds complexity. Another important point is long-term stability. As Bitcoin matures, volatility may decrease. Markets may become more efficient. Price discovery may become more stable. This could make Bitcoin more attractive as a store of value. But this process takes time. Another key idea is generational change. Younger generations are more familiar with digital systems. They are more open to new forms of money. As wealth transfers across generations, adoption may increase. This is a long-term trend. Another important factor is global accessibility. Bitcoin is not limited by borders. It can be used anywhere with internet access. This creates a global market. It connects individuals across different economies. This global nature is a strong advantage. Another aspect is resilience. Bitcoin has already faced many challenges: market crashes, regulatory pressure, technical debates. Despite this, it continues to operate. This resilience builds confidence. For investors, resilience is a key indicator of strength. Another important concept is monetary transformation. Bitcoin represents a shift in how we think about money, from centralized control to decentralized systems, from trust in institutions to trust in code. This is a major change. Such changes take time. They face resistance, but they can reshape entire systems. Another key factor is uncertainty. The future is not guaranteed. Bitcoin may succeed. It may evolve differently than expected. New technologies may emerge. Regulations may change. Markets may shift. For investors, this means managing uncertainty. It means balancing optimism with caution. It means staying informed and adaptable. In conclusion, the future of Bitcoin is shaped by many forces: adoption, regulation, technology, competition, global economics. These factors interact in complex ways. Bitcoin has strong fundamentals. It has scarcity. It has decentralization. It has a growing network. These qualities give it potential, but potential must be realized over time. For investors, the key is perspective. Short-term movements can be misleading. Long-term trends are more important. Understanding the system provides clarity. It allows you to navigate uncertainty. It allows you to make informed decisions. Bitcoin is not just an investment. It is a new form of money. Its future will depend on how the world chooses to use it, and those who understand it early may have an advantage.